So budget methodologies, annual master budget. So as you know, master budget is nothing but a budget which like comprise of all the budgets. So master budget is the culmination and the goal of budgeting process. This is what at the end the company wants to make. It is also called as the comprehensive budget. So master budget is a full set of budgeted financial statements for the budget year, including monthly or at least quarterly interim budgeted financial statements. So every month also they make some statements.
Sir, excuse me.
Yes.
Culmination means group of, sir.
Yes. See, the budgeted financial statements include what? Budgeted balance sheet, budgeted income statement, budgeted cash flow. So I'll just come to this. See, you are supposed to make what at the end of the year under master budget, budgeted income statement, budgeted balance sheet, budgeted statement of cash. So these three things is what we want to see or make. So for this you want definitely some estimates, correct? Suppose if I want to make income statement, you know income statement starts with revenue. So now I want an estimate of revenue. For that I'll make what? Sales budget. Then I have to subtract COGS. For that I want material. So I'll make material budget. Then I will also take labor. I'll prepare labor budget. Then I definitely also, like after that I'll get gross profit and I have to deduct my overheads. I have to make overheads budget. So with this, what is happening? You'll get budgeted sales amount, budgeted material, budgeted labor, budgeted overheads. All these things you can take and you can find out what? Budgeted income statement. Am I right? You can make budgeted income statement and you can get an estimate of gross profit. In the same way, you can have estimates of different figures of balance sheet like cash budget, inventory budget. Like that, some figures you can have and you can make this. And then you can also make cash flow statement and get estimates of cash. So all these are important at the end so that you can use those things and you can make your master budget. Okay. Now, so the budgeted financial statements are prepared by responsibility center, and the responsibility center budgeted statements are consolidated into company-wide budgeted financial statements. That means they will take from all the departments and from everywhere they'll take the inputs. So that becomes a company-wide budgeted financial statement. So individual responsibility center budgets and the consolidated budget together make up master budget. So the responsibility centers will be there, individual responsibility centers, profit center, revenue center, like that there will be a lot of centers. So from them we will be taking the estimates, putting those estimates and making the budgets, clubbing or adding up all the amounts of those budgets, and we will be getting the master budget. Isn't it so? Yes. Now, so a projected financial statement can be called a pro forma financial statement. However, the master budget is not a pro forma financial statement. Okay, master budget is not a pro forma financial statement, is something different. The term pro forma is used to refer to a forecasted financial statement prepared for a specific purpose. That is what if analysis. That means you are having some specific goals in your mind and you want to achieve those goals. For that reason, you are kind of trying to make specific financial statements. So I would say that is pro forma financial statements. If you take budgeted figures and make financial statements, that's not called pro forma financial statement, budgeted financial statement. Did you understand, madam, what I'm saying?
Yes, sir.
So a company might prepare many different sets of pro forma financial statements, which would be for specific purpose. Okay. For the same period in its planning process. A pro forma financial statement is not used for formal variance reporting. For variance reporting, we require budgeted only, standard. We will be comparing that with actual. Now, static budget. Static budget is nothing but you are like preparing a budget for some level of planned activity. Suppose you want to make 1000 units, that you have made up your mind that this is what it is you have fixed. You don't want to be flexible, don't want to go for 1200 or 800 units, nothing. You have not kept any such kind of provision, so it is a static budget. And flexible budget is very simply understood, the budget whereby you keep yourself flexible. It's not only 1000 units, you also try to make for 1200 and 800 units, correct? So more, the higher activity level and lower activity level. So master budget is created using both non-financial and financial assumptions, which come about as a result of planning process. Of course, since you're doing a financial plan for the future, you prepare budgets. For instance, companies develop budgets for the number of units of each product that they expect to manufacture and sell. Madam, just a second, I'm getting a call. Just a second. Now, master budget is a result of both operating decisions and financing decisions. You may be knowing what I mean by this. Operating decisions, nothing but you see, cash flow statement. Cash flow statement. Cash flow statement. You have operating decisions. Correct, madam?
Yes, sir.
Just a second, madam. So, you know how to make a cash flow statement, and madam, did I share the cash flow statements videos with you? Hello, hello, hello,
Sir, no, sir. No, no. I cannot get
madam.
it done.
Leasing and income tax I shared now.
Yes, sir. Yes, sir. But I didn't
Madam, please
answer.
go through that at least. Like you can wind up so that you can start practicing questions now. And this weekend I'll give you that practice material also, madam, completely that hard copy.
Okay, sir. Okay.
Okay. So master budget is a result of both operating and financing decisions. Operating decisions are concerned with best use of company's limited resources. Financing is like the,
Financing.
the funds you arrange for company's needs. Profit plan, you take up all these activities and then you make your estimates, and you try to get your estimated profit. Okay, so master budget is the consolidation of all responsibility center budgets. It comprises operating budgets and financial budgets. So in operating, what you can take, many things. Operating budgets are used to identify the resources that will be needed to carry out the planned activities during the budget period, such as sales, services, production, purchasing, marketing, research and development. All this comes under operating activities, and we prepare budget for all these activities, and then we get operating budget completely. And then financial budgets, like you take cash budget, budgeted statement of cash flows, balance sheet, a capital expenditure budget, etc. That comes under financial budgets, and these two are to be considered to prepare a master budget, because all the departments involved in all those activities will be preparing their respective budgets. Those budgets will be taken and then be framed. They would be used to make a master budget. Static and flexible budgets already told, madam. Here we can see an example, I think, for a static and flexible budget. This is what you can see. This is a static budget. This is a flexible budget. Okay. So what they have done, they already have fixed this. This is what is the level of activity they want at any cost. Actually is what this is, correct? But flexible is like if you want to make, let's say if they have fixed that they want to make 100 units. So this budget is accordingly given. But if they go for 120 units, then this budget comes into picture. And this is actual. Whether they make 100, 120 or 80, that doesn't matter. This is actual, correct? So this is a budget they made. And here is an income statement. This is the income statement based upon these budgets. So here is an income statement showing actual results alongside the static budget, the master budget. So why it's a master budget? Why? Because sales is there, revenue is there here, costs are there, overheads are there, okay, and fixed costs are there. Fixed costs can be finance cost or like operating fixed operating cost. But since we are not going for finance option, we are only concluding to operating income. This can be a a master budget with all these figures, correct? Why we make budget? We make budget to compare that with the actual and to know the variance. Am I right? Whether we are like what we estimated is like whether we were able to achieve that target or not. But we have like let's say if I say about cash budget. Cash budget is nothing but receipts minus payment. So I would see like how much cash I have at the end of the period. Isn't it so? So then I will be comparing, like that would be my estimate, that I estimated that I should have 1 lakh cash, but now when I see I have 1 lakh 20, so my estimate, it is better now. This is favorable for me. Why? Because what I estimated I got more than that. Then so this is what static budget, a master budget. So when a company develops its budget for a future period, it does not know what is actual sales. Everyone knows that. We don't know what can be the actual thing, and production volumes will be in the period. So revenues and costs in the master budget are based on forecasted volumes. The master budget is a static budget because each item in it is developed from developed for one specific activity level. Okay, so each item in that particular static budget, whatever you are including, is developed for one specific activity level. Like we are going to perform this activity, for that how much revenue and how much overheads, how much things what we require. When variance reports are prepared that compare the actual results to master budget. Yes, when the variance reports are prepared where you are going to compare the budgeted figures with what? Actual. Why you do that? To know the variance, correct? So that I have already explained right now. Now, in determining what variances should be investigated, the following factors should be considered. The magnitude of variance, what constitutes a material variance, will vary depending on the size of the budget line item. If the budgeted amount is 1250, $1,000 variance would represent 80% of the budgeted amount and would be important to investigate. Of course, now we understood that some amount should be of this much. But the variance, this much is the variance. That means 80% of this amount is altogether a variance. Madam, like we budgeted that something should be of 1250. Of that, some difference of 250 or 150 is good. But there's a difference of this. That means 1250 you estimated, 250 is what you got. So how much is the variance?
1000.
1000. That's a very crucial thing to be assessed, and that's a very that is a worrisome thing. Correct? We need to worry about that. Why that much difference has been created? Now, trend of variance over time. If an unfavorable variance has been going for several months and is getting larger, that's again should be investigated. Likelihood that an investigation will eliminate future occurrences of the variance. That factor is very important. Like you're putting so much of cost for all these assessments and all, whether you'll be able to eliminate such kind of occurrences in the future, whether your plan is going to be very stronger in that case, that also should be seen. So we made this budget. So they have given all this. You can go through that. Now we'll go for project budgeting. Okay. So project budgeting is very simple. When we want to start a project, I want to invest my money in any of the projects which I'm looking forward. Definitely what I'll be seeing what I'll be doing, I'll be making a project budget, correct? For that specific project. How will I make that budget? I'll see that 1 lakh is the investment is what I'm going to do, and I'm going to expect some revenue, and definitely I'm going to expect some cost, that is variable cost plus fixed cost combined. I'll say total cost. Revenue minus total cost can give me what? Cash flows. Am I right? Yes?
Yes, sir.
Yeah, and then I'll be seeing like every this is what the cash flows I'll be expecting in the future, 1, 2, 3, 4, 5 years, and then I'll be seeing that like at the end, like this is the present value of this. I'll be also finding out the present values of this. I'm speaking about investment decisions, you may be knowing, and then I'll be trying to calculate the NPV and see whether like it's a profitable project or not. Isn't it so? That's what I'll be doing. See, I'm not trying to draw a conclusion here. I'm just seeing that what is my outflow and what can be my inflows and outflows altogether during the lifetime of the project. That's what I'm going to see, and I'm going to budget. Okay, based upon that, I'm going to see whether that project is going to be a good project or profit-making project for me or not. Okay, so as the name suggests, so we see life cycle budget. Now, what is life cycle budget? Let's say we want to buy a car, and we opted for Maruti Suzuki. We opted for Honda. We opted for Verna. We want to take any of the cars, but we see that this is the one which is giving me the least life cycle cost. From the day one when I bought, the cost is less when compared to others. The fuel charges, it consumes very less fuel. It's more fuel efficient. The service cost is very less. Resale value is high. So in entire life, till what I am going to use that, is that going to be a better option than these two? Yes. So there comes life cycle budget. Okay. So now for any specific purpose, we can prepare a budget and we can compare that with the actual. Benefits of project budgeting: management can determine in advance whether or not the project is the one should be undertaken. As I told you, with NPV, we can do that, correct? If the project is giving me a negative NPV, I'll skip the project. If the project is giving me a positive NPV, I'll go for the project, of course. The project budget enables management to plan for amount of resources, that how much people are required, how much efforts, how much supervisors and finances are required and needed. Project budget focuses management's attention on anticipated cash inflows. As I said, revenue minus cost, that's my anticipation, and how much I'm going to spend, that's my anticipation. It helps to foster cooperation and coordination among the various responsibility centers that will be affected by the project. A project budget covers an identifiable project that has its own time span. Limitations are like all our estimates. So, like we cannot always depend on our estimates and always think that it's going to be a true like it's going to be very realistic, and budget amounts for projects must be integrated into the master budget of the company for relevant period and periods. Unless this done, the project cannot be fully utilized. So individually only we cannot depend upon the budget, it should be also considered in the master budget. Now we'll go for the activity based and zero based budgeting. What is activity based budgeting?
Sir, excuse me.
Yes, madam.
In the limitations last line, unless that is done, the project budget cannot be fully utilized.
Yeah, unless
Yeah.
See, budgeted amounts for project must be integrated to this. Master budget is what is the key, na madam, at the end.
Yes, sir. Yes, sir.
That's what. Now, activity based budgeting. 2 minutes. I'll just put some link here. Before going into the budgeting, we'll first know about the costing. What is this activity based costing is all about? Simply understood, you know, madam, like traditional costing, they only take one absorption base, correct? To allocate the overheads. Isn't it so? Hello.
Yes, sir. Yeah.
Yeah, so this is what is traditional costing. Activity based costing. What happens? I know,
Sir,
like,
I understand traditional costing.
yeah, traditional costing is like simple, madam. Like you have overheads. Like, let's say you have overheads, some overheads you have, and you want to allocate that overheads to find out a per unit cost. What you will do? You will suppose 10,000 is your salary. That's an overhead divided by machine hours or labor hours. Correct? So what happens? Suppose there are 10,000 machine, there are 1,000 machine hours. Machine is working for 1,000 hours. You get $10 per machine hour. So that means the salary is $10 for one machine hour if machine works for 1 hour. Correct? What do you understand by this? Traditional costing has only two types of absorption bases, whereby you can find out the per unit cost of an overhead. Correct? But ABC, activity based costing or activity budgeting, I'll come to that. It solely depends upon the activity, what you are performing, and the cost would be allocated to that activity, and based upon how much that activity you are doing, you can find out the per unit cost. So here, what are the cost drivers we should know? So this example would explain you in a better way. You can say this. Julian Company, so traditional costing, we will discuss about that, and also we'll discuss about the activity based costing. Julian Company manufactures fizzy drinks and plans the production of 20,000 drinks for month of July. Direct labor hours, they have given 900, machine hours 600. So this can be the allocation base to find out per unit overhead cost. These two can be used, and the overheads are this much. These overheads can be segregated into three categories: 1,000 for direct supervision, for 350 machine hours. So this is activity, correct? Supervision is activity or not? Logistics is activity or not? Yes, madam. Production setup is activity or not? Please tell me.
Yes, Yes, sir. This activity.
So these three activities differently we are taking, and overheads for these three activities are given to you: $1,000, $1,500, and $3,500.
Okay.
Okay, the cost is given, and as well as the activity levels are also given: 350 machine hours, 540 labor hours, and 30 setups. So for every activity you have allocation base separately given for that particular activity, and separate costs are given. Okay, but in traditional costing what happens? Let's see. By applying traditional costing, the cost driver can only be two things: labor hours and machine hours. So how much is our cost overhead? 6,000 divided by either 900 or 600, so we get this. Okay, but what happens in case of activity? You take three activities separately, you have overheads of that and also the activity levels, and you get the overheads per unit. Am I right?
Yes, sir.
That's what is the difference. That's it. Once you
Okay.
can go to this question, madam, and then see. And I'll
Okay.
just...
Can you share the link, sir?
The link is shared, madam, in Skype.
Yeah. Okay.
Once you can see, you will go to just a second. Madam, if finished, I am just scrolling down.
Yes, sir.
Yeah.
Yeah, complete.
Yeah. Now we'll go for the activity-based budgeting. So activity-based budgeting is similar in concept to activity-based costing. So it is nothing but every activity what we perform, we are preparing budget for based upon that activity, based upon the cost driver. Understood, madam? Now here there were three activities, correct? For those three activities, we are having different overheads and different levels of machine hours, or like we are doing different. We are doing those different activities at different levels. Correct. employing different resources for that. For example, for supervision you are using how many hours? This much.
350.
For logistics this much. For production setup this much. So do you think if your production setup is going to increase, let's say, so your cost is also going to increase, no?
Yes, sir.
Fine.
Obviously.
If it's 35 hours, so it's like 1500 will increase. So it's like when we go to a hotel, what happens? Suppose I'm making a budget, activity based budget. So I want to book a hotel room. So there are like there's occupancy for 2 people, adult, that is like 2 adults. They say no, they give options like 2 adults and 1 children. So if you put 1 adult, 1200 rupees per room. If you book for 2 adults, it becomes 1800. If you add children, it becomes 2300. Correct? Am I right? Why are they increasing that? Because as you increase numbers for them, more and more that drives the cost. Why? Because they have to give more facilities. They have because they have to now whatever whoever the staff is working or whatever the machine they are using or whatsoever they are using, they are giving refreshments, they are giving juices, they are giving whatsoever in the room as a service. That is increasing or decreasing? Increasing. So based upon that, I should plan the hotel should plan or make their budgets, because more occupants increase, they have more expenditure to spend. So they prepare budgets accordingly based upon the activity levels. Correct? Hello.
Yes, sir. Yeah.
You understood, na, madam? Hello.
Hello.
You understood?
Yes, sir. Yes, sir. Understood.
And you know these cost pools are already given. The cost pool is $1,000 for supervision. These are the cost pools. Basically, this will be studying in more details in the coming chapters when we'll be doing costing. So there are some benefits of activity-based budgeting, like you are taking every activity into consideration to make your budget. So in that activity, you are very much able to study that activity particularly, and any wastage or any wasteful activities you are trying to eliminate. Okay. So the process of preparing an activity-based budget brings out information about opportunities for cost reductions and the elimination of wasteful activities. Thus, activity-based budgeting makes it possible to identify and enhance high value-added activities. Yeah, you can like make something possible. You can identify and you can increase high value-added activities and eliminate low value-added activities. That means something which is not adding value to the activity what you're doing, you should remove that. So with this, what will happen? Continuous improvement will happen. Correct?
In that we can remove the extra activities.
Unnecessary activities, yes.
Unnecessary activities.
Yeah, the ones which are not giving any output.
Yeah.
It helps managers to identify resources needed and changes that will be needed in resources. If changes are made in products offered, product design, product mix, manufacturing process, and so forth. Budgeted costs are based on cost for the resources required to perform the budgeted activities, which defines a clear relationship between resource consumption cost and output. Yes, when you make a budget, you know what resources are going to be, what kind of resources are going to use and how much you are going to use. So accordingly, you can see how much is the consumption cost for the resources and what is the output you're going to get, and can help to identify budgetary slack. That means the cushioning, what you keep, like underestimation of revenues and overestimation of expenses. And activity-based budget system makes clear the relationship between. So here you are not taking, or you are not dividing the overheads with just one activity. You are taking different activities, and how much how much labor or machine hours you are employing per activity differs. Now, suppose I take up overheads like this, 10,000 is my overhead, and this is my manager who is managing 3 departments. Do you think and the machine hours are 1,000 and I get $10? Do you think it is justified? When I see that manager is giving is devoting let's say 500 hours in department A, 200 hours in department B and 300 hours in department C. So do you think that $10 is justified? More should go to this department, somewhat less, somewhat less. Am I right, madam?
Sir, yes, sir.
So activity-based budgeting is much more clear or not? According to activity, you are allocating your overheads now.
Yes, sir.
Yeah, so $10 you are bifurcating perfectly, but it's a time-consuming process. That's it. Now, zero-based budgeting versus incremental budgeting. What is this zero-based budgeting? You are starting from zero, from the scratch. You are just starting from zero and you're going on adding up all the expenses or whatever it is to this, and you're making a budget. Yeah, starting from scratch. And incremental is nothing but you are going on increasing the number of going on increasing the cost. That is incremental budgeting. Okay, so we will read out this point. Typically, budgets are developed by beginning with current period's actual or current period's budgeted figures. Suppose you already have a estimate, and then what are you doing is you're adjusting them for any changes anticipated in the coming period. So you already have a budget and you're thinking that in future some changes may be required. Suppose I want to organize a party for 300 people and I have an estimate. Do you think always estimates would work? Because some families who are residing in our society, maybe there are some relatives who came to their house. So can you say them, no, we are not going to allow you? They are guests, correct? Hello?
Yes, yes, sir.
If someone brings their guests to us, can we deny? No, we are social people. Can't do that. We will cordially invite them. No, you should also come and be a part of our celebration, correct? So there what happens, like 30 people extra come out. So we should keep provision of these things or not, these adjustments or not. Yes. Then what would happen? Your budget would increase. That means it becomes your budget, what you have fixed, goes to somewhat higher extent. So that can be said as incremental budgeting. Okay. Correct or wrong?
Yes, sir. Yes, sir.
Zero based I already explained you. You start from very scratch zero. And continuous rolling budget is nothing but you are preparing a budget for January month. That January month you made sales budget, you have sales budgeted figure, taking that as a base, then preparing February budget, then taking that as a base, taking March budget. It's going on continuously, correct? Hello?
Sir, it is a continuous process.
Yeah. So madam, we have finished 3 units. Now tomorrow we will do this one. This is a fresh topic, so wanted to start afresh tomorrow, because tomorrow's class we are going to prepare all these budgets. All budgets we are going to prepare. It will be a lengthy class only, because if I'll be successful in finishing all these budgets, let's say all this what I've explained here, then conclusion immediately next class would be the concluding class. 2 classes more, budgets done. Okay. Sorry.
There are so many budgets on this one. Sales budget, production.
Yeah, one budget only, madam.
Budget,
But what I can do is I can give you some video, like old class videos of mine for these budgets only, which there are different questions I have made them to solve.
Okay.
So if you see that these budgets we can like easily, you can only solve in the class. You can only do it properly. We can discuss.
Okay.
Shall I send those videos to you, madam?
Yeah.
But it will be in Hindi, but normal Hindi only, not like very typical Hindi.
Okay, sir. Okay.
Okay, madam. I have one task to send, like ethics and this topic. So these 2 I am going to send today.
Okay, sure.
Okay, madam. Then tomorrow we'll take the class. Hopefully afternoon, if it's possible, I'll speak to other students and see. Otherwise, like evening 5:30 or somewhere, 5 o'clock something will start. Okay, madam.
Okay.
Thank you. Thank you.
Thanks.